sectors that one should be looking at investing, for next 3 to 5 years?
See the sectors, a few of them are there. Like
Hello, welcome friends to our new podcast with Mr. Ambareesh Baliga. It gives me immense pleasure to welcome him, one of the most respected and credible voices in the Indian financial markets in today's webinar. With an illustrious career spanning over 3 decades across renowned institutions like Kotak, Karvy, Edelweiss, along with his pioneering contribution towards building portfolio management services India, Mr. Baliga has consistently been known for his deep market understanding, balanced perspective, and ability to navigate market cycles with conviction. As a strategic advisor to MF Bharat, his association further strengthens our vision of building a future ready and insight driven wealth platform. Sir, we are truly honored to have you with us today. Looking forward for your valuable insight and guidance.
Thanks, Rajnish, for having me on the MF Bharat podcast. My pleasure.
Sir, you have been, you have seen three crashes. What did 2008 teach you that 2020 did not?
It's not really three crashes, many more.
Yeah,
Since
you have seen much more.
I got into the markets in 1983. Saw
Oh,
a fall around 87, 88. The major fall post that was the Harshad Mehta scam. Then we had the Ketan Parekh scam and the dot-com bust. Then it was the 2007-8 crash, which you're talking about, and finally the COVID one in 2020. And in between, when UPA 1 was elected in 2004, the markets hit bottom circuits. The then finance minister, Mr. Chidambaram, had to in fact come to Mumbai, meet a few of us, the brokers, to find a solution to improve sentiments. So that was the situation then. GST introduction as well as demonetization also saw deep corrections, but it was for a short time. I mean, every crash, there is one thing common. It is the fear which leads to panic. Either you want to get out because you're afraid tomorrow could be worse than what it is today, or someone is forcing you to exit, probably your financier, probably your broker. I mean, as a fund manager, you may also be having huge redemption pressure, so you can't do anything much. You need to sell. So, huge number of market participants panicking, and then it's a rush to the exit door. I mean, just like a movie hall, which is quite narrow. So naturally, there is a stampede. And before most of the crashes, there's generally a steady to steep move up, which had created euphoria. And this cycle continues. You have a euphoria, then you have a crack, and then again, after the market again starts moving up, again you have a euphoria. But many a times you hear that this time it is different, but generally it's not. Again, to borrow an analogy from movie making, I mean the base storyline is the same every time. It's greed and fear. The screenplay possibly is different for every crash. The actors, or here we talk about the market participants, I mean, they could be different because every boom and bust, many old participants take a back seat and the new ones come forward because a rally generally is led by new participants. I mean, for example, the post-COVID situation, 20 to 2024, it was thanks to a lot of new money which came in from the retail. I mean, first-time investors, either directly or via mutual funds. Now, coming to your question, the only thing common between 2008 and 2020 was fear. I mean, we didn't see a huge euphoria before 2020, although from 2014 to 2020, the markets were steadily moving up. But there was euphoria before 2008 fall. I mean, the subprime bubble had burst, toxic assets were out in the open, complex mortgaged-backed assets were going for a toss. So people were rushing to get out before the investments fall further. But in 2020, the fear was whether you live to see 2021. So when it's purely economy related or certain factors like geopolitics or a scam or an asset bubble bursting, you have a feel that let me exit now maybe I'll buy it back later at a lower price. But then in 2020, the question was your life as well as your loved ones. So investment was the last thing on your mind. So when reality hit us towards the end of February 2020, that COVID is at your doorstep. It is not in other countries, but it's at your doorstep. That's the time all hell broke loose. So in short, 2008 was the fear of your portfolio going under. 2020 was fear for life because no living person had experienced this sort of a scenario. I think the last such scenario was in 1919, so about 100 years back. And COVID the situation again reiterated that such panics should be utilized to buy. Because if you survive, you get the benefit of investing at low valuation. If you don't survive, anyways, I mean, it doesn't matter to you, but your inheritors will enjoy the fruits.
Okay. Okay, sir. Bull markets make everyone look smart. What mistakes do investors repeat every cycle?
I think the biggest mistake which most of the people do in a bull market is buy on tips. They don't want to put in hard work, but the hard earned money is invested based on tips because they don't do any research because everything is moving. They feel that if they try to do some research, they'll miss the move because it takes time to do research. And they feel that, I mean, if it like the issue is that like in a bull market, people just hear this phrase called "अच्छा लगता है," and most of the retail money is invested based on this phrase. And people get carried away. I mean, they don't want to sell because of greed, want perennially higher levels till the market cracks or the specific stock cracks. And then you wait for a bounce, which never really happens because when the market starts correcting sharply, those bounces are very, very, very shallow. And you wait for the earlier high you had seen, but that never happens. So it's important to do periodic profit booking, especially when the stock has moved beyond your best normal case targets. But then all these targets are realistic only when you've done research, not when you have invested on tips.
Right. So, is buy and forget dead in today's markets or more important than ever?
I think buy and forget is dead. In fact, I don't think it was ever the right concept, although we hear it a lot. Basically, people say that buy and forget. You've heard that in the past a lot because we hear so many stories. I mean, my granddad or dad bought such a stock, and we discovered the shares recently. It has created such a huge wealth for the family.
Right.
But nobody tells you that their granddad or they themselves have invested in a great idea 10 years back, forgot about it, and now the stock is delisted. It's worthless. No one tells you this. So you can't buy and forget, period. You need to keep a tab on what's happening and take action accordingly. I mean, those who buy and forget are really playing on the luck factor. And then there's no difference between investing in the markets and the casino. So when you have invested, you need to keep a tab.
And I think today's world, I mean, is so dynamic. I mean, we're all interconnected. A lot of things are changed. You cannot
Yeah, yeah,
take a call for 10 years.
absolutely.
Nigam.
Absolutely. The things change in 3 months.
Yeah.
Forget a
Right.
year, 3 months, things change.
Okay, so we are seeing, FIIs have been selling and DIs have been, trying to control the market. I mean,
Right.
do you think it even matters, for people who are looking for a long term, let's say 8 or 10 years investor long term view?
See, for a long-term investor, it should not really matter as the portfolio performs based on the economy in general and the specific company in particular. But if you look at the longer-term history, FIs have kept buying and selling. I mean, most of the times the domestic funds do the reverse, and this goes on. However, FIs have been continuously selling for the last 2 years. And that's been a bit concerning, although you had the domestic funds more than matching the FII flows. But FII flow, I mean, outflows currently point to a structural issue. And I think the major one possibly is the FII taxation. And then generally, whenever there's a geopolitical issue, there's a flight to safety. The rupee
Right.
has been weakening, and that's another reason. The markets have been underperforming. And like I said, rupee weakening was a double whammy because currently you have the Latin American markets, South Korea, as well as Taiwan. I think one of the reasons has been the AI push, especially for South Africa, I mean, South Korea and Taiwan. So based on the demand for semiconductors and memory chips, I mean, these markets have been doing much better. However, long term, I truly believe that FIs may not grow markets, the Indian markets, as it should be among the few economies which will continue to perform or outperform. So I think we may need some amount of patience. And when you're talking of a 10-year investment, that means that the investor has a decent amount of patience. So I don't think it should really affect. FI should be back again.
Okay. So, what do you think? Where currently India, and we saw rally in Japan, over I mean lasted for 10-15 years. Then we saw US in 1990s, type. Do you think India is in that type of growth story currently?
See, I believe India has all the ingredients required. I mean, whether it's political stability, capital generation, the equity cult is increasing. I mean, we have seen, especially in the last 4 or 5 years, I mean, we've seen multiple amount of growth as far as the equity cult is concerned. The required technical expertise is there across various sectors. And in fact, if you see, Indian overseas are actually leading the cutting edge technologies. And we have one of the youngest populations across nations. I mean, most of the nations are growing old. We are currently quite young comparatively. And we should see multifold growth over the next 2 decades because of Viksit Bharat, which the focus is on. But I think the very important thing in, in this whole scenario is that our youth needs to be gainfully employed. I mean, we are talking of a population matrix and a demographic dividend, but that's a double-edged sword. Because if the youth is gainfully employed, then consumption increases, the country's output improves dramatically, and there's overall growth. On the other side, if the if the unemployment rises due to a variety of reasons, I mean, one of them could be the mismatch of skill sets required. Also, we should understand that not all graduates can be suitably employed, and many young graduates are also underemployed. I mean, you have graduates and postgraduates becoming Uber drivers. So I think, I mean, unemployment among the youth, I think that can lead to social unrest, which could actually hamper the overall development of the economy. So I sincerely hope and believe that the government would focus on this because our programs like Skill India have still fallen short. But if this aspect is set right, I don't think anything can stop us from becoming a developed country by 2047.
Right. Good. And sir, active versus passive, we hear a lot of debate on that. Where do you stand? I mean, in 2026.
Active, not just 2026, across all years. Because if I didn't know anything about investing, then passive would have made sense. But as an analyst, my skill is to find winners. I mean, I could go wrong, but net, I should be able to beat the index. However, yes, I mean, I would also use passive investment strategies as a part of my overall investment strategy. If I will, for example, if I'm bullish on PSU banks, I mean, I could use the PSU bank ETF as one of my investments. But
Yeah, now a lot of people are running after ETFs.
yeah. But I mean, I don't believe in 100% passive investments. I mean, it may work for someone who doesn't have that inkling for investments, doing research, but needs to invest because end of the day we need to, outperform inflation. and create wealth. So yes, I think passive investments for them make sense.
And sir, you have so much, experience. I just want to know one, stock market lesson, you learned the hard way.
See, most of the lessons you learn the hard way in this market, I think always remains imbibed. So one lesson I've learned and the habit I have made is be happy, don't regret. Because when the market moves up, most of the people make money. But do you think everyone is happy about it? No. That's because somebody else is making more money than you. And you always end up comparing. Similarly, in a bear market, you are more unhappy if your losses are higher than those around you. In fact, you feel satisfied if your losses are less. This is quite ironic, I would say. So try not to bother what is on someone else's plate. Try and maximize what is on yours. And I think another mistake which a lot of people do is regret their mistakes. Because investing also means you keep making a variety of mistakes. You need to keep learning. No point regretting a wrong decision because regretting takes up a huge amount of your mind space, which again means that you turn a blind eye to the next available opportunity because you're busy regretting. I think we should learn to move on. So it took me a while to learn this art, and currently I'm at peace with my investments.
Yeah, yeah, people, if, they're not happy even if the market goes, then they think they have sold early. If they buy down, they think they bought early. So it's always like that. 70% actually market investment is behavior, and 30% is stock picking.
That's true.
Okay, sir, and how should one pick up a sector or a stock, to invest?
See, finding a sector in flavor is not difficult. You can talk to a cross section of people, you'll know which sector is in flavor of the season. And when you deep dive a bit in the sector, I would say you should look at the leader in the sector. Like a very simple thing would be to just pick up two stocks from the sector. So the first one should be the leader in the sector. And then look at an emerging leader, which could be a mid cap or a small cap, because the leader will provide you the stability and cushion, but the superior returns could actually come from the emerging leader. Because that stock would get re-rated, but there are some important ingredients which you need to look at, some important parameters, and I think one of the most important thing would be the management. I think it should be decent, should not have any red flags in the past. Again, the company should have positive operational cash flows or at least a decent visibility of that. And there should be a good enough logic that it will continue to grow and outperform.
That's great. Thank you. And sir, where should a younger investor, who just started his job, invest? Who is looking at, investing? What should he be doing? How should he look at his, asset allocation?
See, asset allocation is absolutely important. For a safe long-term investing and wealth creation. I would suggest about 60% in equity, 30% in debt, and 10% in gold. And I would not consider investment in property, which is your primary residence, as an investment. So in equity, again, based on your risk profile, invest across large cap, mid cap, and small caps. To be on the safer side, because 60% I would suggest invest in large caps, 30% in mid caps, and about 10% in small caps, if at all. And debt, I would say preferably invest in higher rated paper, because if you're going in for a lower rated paper for higher interest, instead of that, invest in equity. And you can also be investing in REITs and InvITs. Keep some funds in FD or liquid or arbitrage funds for your emergency requirement. Gold, although it's performed extremely well in the last year and a half, but limit that to about 5% to 10%. And again, here, I will not consider the gold jewelry as an investment. So gold which is meant for investment, has to be separate.
Yeah, I think that, I mean, what you said, we can do it through a mutual fund route also. I mean, there is multi-asset funds are there where you can take equity, debt, and gold exposure.
Absolutely.
And so, what advice would you give to a 25-year-old self who's starting today?
I mean, if I was a 25-year-old looking back, I would possibly suggest a higher allocation and concentrated portfolio, especially where,
Allocation to equities.
yeah, I'm talking about equities because
Uh,
I'm primarily an equity person.
yeah, yes.
So, I mean, I would say as to where your conviction levels and confidence levels are high, I mean, give a much higher allocation and have concentrated portfolios. I mean, although there is no guarantee in this market, it's only probabilities. But as long as your winning trades are higher than your losing ones, I mean, you're a winner. You create immense wealth. I mean, compared to someone having a very wide portfolio, because I've seen so many people having 50, 100, 200 stocks in their portfolio, and that never really performs. So I've been following a portfolio of about 25, 30 stocks, but still, if possibly I had a 12 to 15 stock concentrated portfolio, possibly I would have performed much better.
So I mean, we see a lot of action in cryptos, F&O options, and small caps. By this new generation. I mean, why do you think is this Gen Z is so much addicted to risk?
See, our pace of life today is much faster than what it was in the past. I mean, could you imagine a 10-minute delivery a decade back? So Gen Z needs instant gratification. And what better than the huge volatility that crypto or a F&O or the small caps really provide? So if they have limited means and they're deploying their own money, they learn faster. If they have deeper pockets and have freely available family funds, I think their learning process is a bit slower. So when I say learning, it means either they learn and trade well and manage to get more winning trades than the losing ones, or they learn that it is not working out for them and they need to look for other safer opportunities.
I think this generation they want everything quick.
Absolutely,
Uh,
absolutely.
I mean, Gen Z today wants, I mean, 10 times, return in 10 months. I mean, so I think what is the reality check you think they need?
See, one thing is every day is not a Sunday. And the earlier they lose, the better it is for them. Because you may have the beginner's luck playing out. You may multiply your money in a short while, especially when the market is super bullish, closer to euphoria. And you think that this is going to continue forever. I mean, that's what happened in 2024. Most of the people thought that this bull market will never end.
Right.
And most of the losses happened in that space, I mean, the small and mid caps. And when you start thinking that this is going to continue forever, you end up deploying more. So typically, you start earning on a lower denominator, but when you lose, it's on a much higher denominator. I mean, for example, you start with an investment of 1 lakh and you get very lucky, you double your money in no time. You add another 2 lakhs. Again, you make another 50%. So, like this, you keep adding, the investment goes to 15 lakhs. And when the market cracks, possibly your 15 lakh portfolio becomes 6 lakhs. And you have
Mm.
probably lost all the money you made plus your capital. So, better to learn some tough lessons in your initial phase of the journey.
Okay. So, what did your generation get wrong that this Gen Z is getting right?
No, I think ours is a typical generation which was caught between being too conservative in your upbringing, looking at your parents, and aspiring to be capitalist, looking at the achievers among the global leaders in those days in US and Europe. As a generation, we were lower risk takers than the Gen Z. We didn't have the global exposure which the Gen Z has today because our generation was more of a follower of global trends, whereas today's India's Gen Z are, I think, among the trend setters.
I think that's why, I mean, our generation was into gold, real estate, and these people are investing into now equities and cryptos and others. And also, I think it's also because of the, information. We didn't have that type of knowledge, information. Now that's freely available to them.
Yeah, because a lot of this information is available. I mean, like during our times, if I go back that 35 years, I mean, in a place like Calcutta where I was staying, I won't get economic times on a daily basis.
Oh my God.
I mean, I had to get the Bombay Stock Exchange rates maybe in the evening, the previous day's rates in the evening, because I mean, the Bombay Economic Times used to come to Calcutta only in the evening.
Yeah, I used to even, hear some experts talking. They said that even the balance sheets were not available. You have to send a letter to the companies and used to get it after, long.
Right, right. And beyond the annual reports, there was not much of information anywhere.
Anyway.
Yeah.
Sir, another thing I've seen is that this Gen Z, they hate patience, okay, because they want everything quick. Now, how do you sell them an SIP, for 10, 15, 20 years?
That I don't think should be too difficult, because end of the day, everybody, whether it's Gen Z or someone who is about 35, 40 years old, everyone has aspirations. And if you can convince them that their aspirations may be fulfilled with the right SIPs, I mean, keeping aside a small amount, I mean, like on a monthly basis, should not be too difficult, because and again, at the same time, it doesn't require too much of efforts. It's just a few clicks and you're through. Because they will continue to love their active trading. But I think this SIP will work in the background, giving some amount of cushion for them. And I suppose once they start a SIP, in the next 2 or 3 years, they themselves will look to open more SIP accounts. So SIPs are there to stay.
So they should actually advise that to keep two type of portfolios, one for the short term and one for the long term, so that could be through the SIP route.
Yeah, because see, the short term normally happens through their trading,
Hmm.
whereas SIP will take care of the longer term portfolio.
Okay, I think leaving the Gen Z side, I mean, sir, how do you think, how should, the gig workers, we are seeing like Uber drivers, these Zomato delivery guys, these guys are also started earning a lot, 35,000, a month they earn. I mean, how should they start, look at investing? Because we see, very less investment from them.
See, SIP again, I think is the best route for them also, because not everybody, I think, earns 35,000. Even those who are earning possibly 15,000 rupees per month, I think 100 rupees per day should not be too difficult, and that's the minimum one can be investing in SIPs. And 100 rupees a day, 10 years of investment, you get back 8 lakhs, which is decent, assuming a 15% CAGR. But I think unfortunately, many of them are hooked onto betting apps. I mean, if you look at the numbers till some time back, I mean, we have 18 crore demat accounts, and Dream 11 alone has 25 crore registered
Yeah.
users. So, anyway, now Dream 11 is getting into stockbroking. So, let's see as to how many of these people get converted to investing.
So again, whether it is Gen Z or whether it is gig, everybody wants quick money. So that's why
Absolutely.
you gamble and all. But yeah, I think 100 rupees a day, if you say, and I mean 10 years, yes, it becomes 8 lakhs. I mean, that's a good number for them. They should start looking at that.
Yeah, I think that's the minimum one should be looking to do. And it doesn't hurt. I mean, for any gig worker, 3,000 rupees a month should not really hurt.
So one big risk for Indian markets in the next 12 months that you see.
No, see, there are a number of potential risks. We don't know as to which will actually play out to become the major one. I mean, currently we are seeing the geopolitical risk, and if the US-Iran issue continues to get prolonged, I think oil prices may remain at elevated levels. Supply chain issues will continue. Now, till now, retail prices in India have not been increased as far as oil is concerned, but they could get increased sooner than later, which will have an effect on the inflation, because the government and the PSU OMCs can't afford to bear it much longer. then rupee has been falling further. So in case we see a further fall from here, that can be another issue. And last but not the least, I think is monsoons, because after very good monsoons in the last couple of years, I think we are expecting a below normal monsoon. So if it is much below, then I think that could affect the economy. So these are a couple of things one needs to keep in mind.
And so if you see just current in short term, I mean, just US rates, Iran war, crude, domestic consumption. I mean, what matters more for the Dalal Street now?
I think it's more of the Iran war which is affecting the Wall Street and its effect on crude, basically, because the war directly doesn't have any effect on us because we're not involved in it. Um, I mean, it is a side effect which we are feeling right now, and more so because of crude as well as the supply chain issues. And right now, if the crude prices increase is passed on to consumers, it can affect domestic consumption to an extent because inflation will straight away move up. And we have been expecting better domestic consumption and hoping that that would cushion the external shocks. But now, with the possible hike at the retail level, I mean, doubts to be cast on that sort of a growth which you're talking about earlier.
Right. So for someone who is fully invested currently in the markets, what should they be doing?
See, we are living in uncertain times. Something or the other keeps coming up. So always better to have some liquidity for a bad day or those bad days when you can buy stocks from your list at a discount. So what I would say is if you're fully invested right now and had invested during the major fall, and those stocks surely would have shot up in the last few weeks, I would say book some profits, keep some cash on the side.
Okay. And sir, I mean, someone who is sitting on full cash or, just starting now to look at investing, what should they be doing?
See, I mean, you have missed a superb rally in mid cap and small caps, but like I've said, do not regret. Start investing in stocks where there is still a valuation gap, but avoid FOMO. Wait for the next fall to get fully invested. And unlike in the past, I think we see that gap between the boom and bust is reduced. I mean, we are witnessing compression of time cycles. So the next opportunity may not be too far. So avoid FOMO and look for those specific stocks where you see that valuation gap.
So, I mean, which are these sectors that one should be looking at investing, for next 3 to 5 years?
See, the sectors, a few of them are there, like specialty chemicals, which after a long gap is seeing at least some potential now. Auto ancillaries, I would say, especially the ones which are more EV focused, EPC players, then the BFSI space, again, I mean, insurance and the banks, railways and railway related. Power sector, I think, should do extremely well in the foreseeable 4 to 5 years. And consumption, unless really things go wrong, I think consumption should do decently well going ahead because that's more India specific.
Right. I think we're through with the questions. Thank you very much, sir, for your insights that you have given, and we really I look forward to do more webinars with me so that our clients can get insights from you. Thank you very much.
Thanks, Rajnish, and I look forward to future podcasts with you. Thank you.
Please stay tuned and follow us on Instagram and YouTube, and we'll keep getting you good insights like this from experts in the markets. Thank you.